G'day folks, and welcome to an on-chain update for the 29th of April. Now today I want to cover a tweet that was put out by Jim Bianco, whose analysis I followed for a long time, and I really do respect it. I think he really is quite good with actually running the numbers, but one of the conclusions that he came to didn't quite gel with me in my experience. So what I wanted to do is actually dig into some of the charts and just explore some of these mechanics and some of the ideas that he was talking about to really see if we can kind of give a bit of rounding, or at least get some kind of an idea whether he's on the money or not. And really that question is all about, are the ETF holders going to panic? Are they likely to be kind of degenerate retail traders who are just going to sell the moment the momentum dies off? This is kind of the crux of the question we want to answer today. So just going to start very quickly with Jim's tweet. He's got a couple of different observations. There's probably about three things that I want to pull out of it. This is all coming off the back of the new filings coming out. So over time with TradFi data, well, very, very slowly, we're getting to see some of the entities who have actually acquired these ETFs. And if we look at it, the first observation that he has is if we look at the trading volume, if we look at some of those filings, generally speaking, the conclusion he comes to, and probably rightly so, is that most of the ETFs is full of retail, and we're still waiting to hear from hedge funds, mostly not institutional investors and mostly retail. And I wouldn't disagree. Based on the data, that appears to be the case. And really, this is where we're getting into the story at hand. Now, this was a tweet that really got me thinking. The fear is that these retail investors are paper hands ready to bail out at the first sign of trouble, right? So we're going to explore this. We've got a similar chart that we'll look at on the ETF flows, so I won't spend too much time on this, but this is the first thing that I want to answer. The fear is that they are paper hands ready to bail out at the first sign of trouble. Now, the other point that he raises, which is really, really important, is actually this cost basis here. If we look at the average cost basis coming into these ETFs, he's pegging about $58,000. And if you've been following my channel and our Substack for a while, you'll notice that we've been talking about this number as well. Not quite 58, but in that 58, 59 region, because that's where we consider the market to be top heavy. So moving forward, we generally agree with this 58,000. We generally agree it's mostly retail. Where we really disagree is that they are paper hands. And we're going to explore that in a bit more detail. So first things first, why $58,000? Again, we've covered this in great detail in our Substack where we talk about top heavy markets, and also in our video that we put out yesterday. Really, that is the short-term holder cost base of $59,500. That would be a level where we could potentially transition into a top heavy market. So not only would the ETFs move into a loss, but we would also see a fairly substantial amount of spot coins, which of course includes those because those coins have been moved in the spot market into the ETF. So just kind of rounding that section out. Now, this is where we're going to talk about the ETFs. And Jim had the chart, and he was basically showing that as price peaked, which is in here, this is where we got to our $70,000, $73,000 peak. We can see that inflows are indeed cooling down as the market consolidates, right? We've got price chopping around between 73 and a low of just under 60 through this whole process. No question. And there's no debate. We are seeing a slowdown in inflows. Now, one of the key points he raises is that GBTC and the outflows that we're seeing are indicating that there's some kind of paper-handed selling. Now, I just want to turn off GBTC for a second. And yes, we can see a couple of outflows, but these are very, very small. In terms of total outflow volume, it is primarily coming from GBTC. It is the structural sell side, and I actually expect that GBTC will continue to be structural sell side moving forward. If we really think about what it is, it's a very, very high fee exposure to BTC, 1.5% versus 0.2% in the others. It is no longer got the dominance in terms of trade volume. It's generally seeing outflows for pretty much the entire time since the ETFs went live. It traded at an enormous discount. In many ways, Grayscale did a number on their customers. I'm not surprised in the least that people are going to sell GBTC before they sell any of their other exposure to BTC. So as a result, let's just turn this off. To me, I'm not yet seeing, even though price is correcting, yes, we've had a reduction in inflows, but remember, reduction in inflows, most ETFs, like just full stop, most ETFs have zero net change day on day. So this is not an abnormal behavior, and trade volumes and activity and things always slow down during a correction. So sure, if we get a break below 58K, maybe those things can transition and shift, and maybe Jim will be proven right. I'm not saying that he's wrong. We're slowly building up this case, but I think it is important to just understand that GBTC is dominating those outflows. across the rest of the ETFs, whilst, we really just haven't seen a great deal. So I'm not seeing any of that degen selling just yet. So now I want to talk about panic. Are they starting to actually panic? Now, what we've got shown here is realized profit and loss. Now, this is the cool thing, right? TradFi may be slow in the data that it produces. TradFi, you may have to wait for people to file. Bitcoin gives us a quarterly report every 10 minutes. And from that information within the blocks, we can look at what is the psychology of the investors who are moving their coins. And considering how large and the amount of volume that moves around every day, as a bit of a hint, somewhere between 30%, sometimes up to 80% of spot volume is flowing in and out of exchanges every single day in on-chain deposits. All of those coins carry a signature. So if you were to survey a population, you don't have to survey every single individual. You survey a statistically significant subset, and then you extrapolate. And on-chain data allows us to fill in the blanks between when TradFi puts out information, and we can really start to judge what's going on in the rest of the market and use that as somewhat of a proxy. So what we're looking at here is realized loss. Now that means coins that were acquired at a low cost basis being spent at a higher, so they acquired high, sold low. People buy high, sell low. That's the indicator. Now, we talked about top heaviness before. We can see that when the market goes top heavy, people also start to panic. So very, very high levels of realized loss is panic, right? Now, note this. We saw in 2021, massive spike in realized loss when 3 Arrows blew up in June, and then again when FTX blew up. This is panic. This is what panic looks like. Now, during bull markets, we get periods of micro panics, right? Because corrections literally have people buy high and sell low on a micro time frame. Where we are in our current market, let's stick this onto cycle 4. On our current market, following the end of the bear at FTX, we saw a couple of periods where people were a little bit uncertain, thought the market was going to roll over, a couple of periods of loss. But for the most part, we've really descended down into what I would call a bull market baseline. We get the occasional uptick because of a correction, and then away it goes. We get occasional uptick because of a correction, and then away it goes, right? You can see the difference in May 2021. This was the start of a bear. This looks very different to this, right? This looks very similar to this. So to me, this is telling me we don't yet have panic creeping in. Now, of course, if we get below 58K, I'll tell you what, that's going to be our test. We will start to see. And actually, you know what? I wouldn't be surprised if this upticks. The question is, do we get a regime shift where it remains elevated, bear market things, or do we essentially recover and go back down into our bull market rally where there's just not that many losses until the next correction comes along? Thus far, looks kind of similar to our previous bull periods. So now that we've really rounded out, we're not seeing panic just yet. We've got a threshold at about 58K that we should be watching and paying attention to, because that is kind of the area where some of these mechanics will start to kick in. So really important to be tracking that if that were to happen. The final question, so we agree that retail holders are in. We agree that 59,000 or 58,000, somewhere in that area, is a key area to watch. We disagree a little bit in terms of is it GBTC that's dominating the outflows, or is it actually degen traders? If we just take all of that as a given, they are retail holders by and large. Are retail holders degen money, or are they stronger hands? This is the ultimate area where I think Jim and I disagree. So let's assume that these ETFs are absolutely jam-packed full of retail. Here's a story, right, plotted out in a chart. We're looking at the 90-day change in the balance of what we call shrimp, or shrimp and crabs, right? Shrimp are people who have less than 1 BTC in a particular UTXO, and crabs are those that have 1 to 10. So we're talking about smaller holders, right? We're talking about small holders here. This is their 90-day rate of change. And I've got the blue line here as the 90-day new coins, right? Issuance being mined, just for a sense of scale. So you can kind of see what I mean here. So here's a bit of a story, and it's actually my story, funnily enough. This was me. I bought here at the very, very top. This is when I first bought my Bitcoin in 2017 at the absolute pico top, so high you actually couldn't have bought higher than me because Coinbase had an extra fee for Australian dollars. So my buy was actually above the top tick when I did my taxes. Pretty nasty at that point in time. Lots of people did that, right? I wasn't alone. Lots of people bought this high, and we got rinsed and minced and chopped around for the entire year that followed. Now, 2019 was a really formative year. I discovered on-chain analysis, started studying and teaching it. We can also see that 2019, there was an uptick. There was a bit of a resurgence. These smaller guys started buying. And I can tell you that between the kind of educational content around Bitcoin back in 2018 versus where we are here in 2022, 3 and 4, whole different world. This 5-year long period that we're looking at, the education around what Bitcoin is and why it's here, which is primarily dominated by retail, by the way, is essentially that it didn't exist back here. It has grown through that period. So we saw a big resurgence of buy side coming into the halving, right? Following March 2020, all of these things, there was a lot of retail accumulation here. The reason why I'm showing you this is that retail in most markets is the dumb money. They may actually not be that dumb here in Bitcoin, because here we are in June, right? Remember that capitulation signal? We know that people panicked like crazy here in June 2022, and then again when FTX blew up. We know people panicked. We can see it. But look what else was happening. We had the shrimp and the crabs stepping in and buying what is pretty much the highest level since they bought the top. Now, this was 20,000. This was broken below 20,000. This was 15,000. So they bought at this level in a bull, but then they bought the same level in a bear. Imagine what kind of hardcore hodler you need to be. I mean, the narrative when FTX blew up is that Bitcoin is dead for a decade, and these folks still stepped in. So the story I want to paint here is that maybe retail actually aren't that dumb after all. Maybe they're not so degen. Most of the degen activity has gone into the rest of the crypto world where it probably belongs. What we're seeing here is actually a whole lot of people who really know why they own it and what they're doing with Bitcoin. Why do they hold it, especially in the modern world that we're in with fiscal dominance and all the rest of it? Now, this next chart is the same model, except instead of looking at it on a 90-day period, what I want to look at it is on a 30-day period. So much faster. We'll see that thing turn around much, much quicker. Just work with me and say, well, maybe the shrimp aren't the degens that we think they are. Well, they did, in fact. Not only did they buy the bottom here in June 2022, and then again in November, December. That's a good move, right? Stepping in at 17K and 15K. That's actually not the worst move of all time. But notice that as we cracked up into the ETFs, the shrimp actually sold. We're starting to get a picture that maybe these folks aren't that degen and dumb after all. They took profits on the rally higher. And now that we're consolidating and really finding our level, and to be honest, there's a lot of metrics that we've covered in our recent Substack articles that really describe this correction and why it looks pretty healthy. And overall, we're actually fairly constructive on it. They've moved back into sat stacking. Now, the last thing I want to touch on is I mentioned that this chart really speaks to me because this has literally been my journey, right? I was in these peaks. I've been around on the first peak. I've kind of seen these different journeys. It feels right because I lived it. I was this guy. I was this shrimp. I'm also this shrimp, right? These things align with where I currently have my gut instinct. So in many ways, what we're kind of seeing playing out may be that retail actually aren't the dumb money signal that they are in most other markets. Now, again, let's see if the market tests that 58K level. Let's see what happens at that point in time, because no question, I agree with Jim. We'll see an uptick in losses. We will see some people panic. But do we see bear market level panic? Do we actually see retail bailing out? If retail actually are the ones that own these ETFs, are we looking at a complete panic scenario? Or is it something a little bit more stable? And actually these people are around for a longer term. Now, the last chart that I want to look at, this is looking at the amount of supply, right? Broken down from 0 to 100%. In the blue, we've got long-term holders. In the red, we've got short-term holders. In the darker shades are the coins they hold in profit. In the darker colors, in the darker shades, we've got coins that are held in loss, which obviously expand during bear markets. Notice here, just take the aggregate total blue line. We have pulled down as GBTC sold those coins, right? But notice where we are relative to previous cycles in terms of the percent of supply. Even after GBTC have seen all of those outflows, over 300,000 Bitcoin, plus another 900,000 from just hodlers in general, we are still at the pretty much top level of how tight the supply was here in 2021, before the bull market started. And if we go back to that level, we're actually at a higher level than we were before the 2017 bull run. Even though we've had a huge amount of coins come back into circulation, we are still in a position where most of the supply is held by long-term holders, and it's actually as tight as it was in the 2021 and the 2016, the start of the bull run. So, again, we don't know what the future holds. What we're trying to do is bound the problem, understand the mechanics that's going on, key levels to be paying attention to in that 58, 59K range, but really just asking the question, are retail really the dumb degenerates that we think they are? Yes, they are in other markets, but Bitcoin is a slightly different beast. It's got a very grassroots origin. And, having lived this experience myself, just doesn't quite feel right and sit the same way the more I spend time with this data. Anyway, hopefully you found that useful, folks. Please let me know your thoughts and comments in the section below. Check out our Substack over at checkonchain.com, and I'll see you in the next one. Cheers.